The collapse did not arrive with sirens or headlines. It arrived as a trading halt that lingered too long, a balance sheet that stopped reconciling overnight, a major financial institution quietly ring-fenced by regulators before dawn. The screens showed temporary, but the word was cosmetic. Internally, the failure was already complete. Liquidity evaporated in hours, not because money vanished, but because trust did. The institution's silver desk, once dismissed as a peripheral operation, became the epicenter. Paper obligations multiplied beyond delivery. When clients asked for metal, they were offered cash. When they refused, the system froze. This is already happening. History does not repeat, but it rhymes with discipline. In 1933, the threat was hoarding, and the response was confiscation by decree. In 1971, the problem was gold outflows, and the solution was a weekend announcement that rewrote reality. In 2008, it was leverage disguised as innovation, resolved by socializing losses while privatizing control. Each time, the public was told the measures were temporary, necessary, stabilizing. Each time, freedom narrowed and control hardened. This moment belongs to that lineage, but it is not a repeat. It is an escalation. The hidden mechanism is simple enough to explain without equations. For decades, physical silver existed as a rounding error beneath a mountain of paper claims. Futures, options, swaps, unallocated accounts, exchange-traded promises. Each layer assumed the next would never demand delivery. This worked as long as price discovery was managed and participation remained obedient. The institution that just fell was a keystone in that architecture, a market maker whose true function was not to trade metal but to absorb pressure, to settle in cash, to ensure the illusion of abundance. When industrial demand surged and sovereign buyers quietly withdrew supply from Western vaults, the keystone cracked. Paper could not become physical on command. It never could. Manipulation was never a conspiracy. It was policy by other means. Prices were capped not to protect consumers, but to protect confidence in fiat systems that require obedience. Silver, unlike gold, is consumed. It disappears into electronics, solar panels, medical devices. You cannot print it. You cannot recycle it fast enough. Suppressing its price suppressed a signal that the monetary order was failing. The moment the signal broke free, the institution's risk models became artifacts. Margin requirements were raised mid-session. Trading rules were rewritten in real time. These are not reactions. They are confessions. The banking system's fragility is not a future risk. It is a present condition masked by language. Banks do not hold deposits. They hold claims. They do not manage risk. They distribute it upward to central banks and outward to the public. When a major institution falls, it is not allowed to fail in the classical sense. It is absorbed, paused, restructured, its losses smeared across the system through accounting maneuvers that require silence to function. The silence is enforced by complexity. The media calls it technical. It is not technical. It is terminal. This time, recovery is impossible because the inputs are gone. Trust has been consumed. Energy is constrained. Supply chains are political weapons. Demographics are inverted. Debt has crossed from burden to identity. Monetary debasement is no longer a tool. It is the environment. Printing does not stimulate. It anesthetizes. Rates do not signal risk. They signal desperation. When silver prices detached from paper quotes into private markets, it revealed a truth the system cannot reconcile. Value exists outside permission. The East understood this earlier. While the West perfected derivatives, the East accumulated physical assets and production capacity. Gold moved quietly from London to Shanghai. Silver left exchanges and entered factories. Payment systems diversified. Trade routes hardened. This was not ideology, it was preparation. The power shift is not announced because it does not need to be. It is measured in shipping manifests, refinery throughput, and bilateral settlements that bypass legacy rails. The fallen institution sat at the intersection of the old world. Its failure accelerates the transition by removing a buffer. Confiscation no longer requires force, it requires control. Access replaces ownership. Accounts replace cash. Compliance replaces consent. When trading halts prevent exit, when withdrawals are delayed for security, when conversions are mandatory for stability, the result is the same as seizure without the optics. Savings become entries in a database subject to policy. The institution's clients learned this when their silver was settled. In currency they did not request, at prices they did not recognize. The law permitted it. The rules were changed to make it so. Mainstream media will frame this as an isolated event, a mismanaged desk, a rogue exposure. They will quote officials who speak in passive voice. They will avoid the word silver, preferring abstractions. This is not ignorance. It is containment. Naming the metal names the mechanism, and naming the mechanism invites replication. The public is not supposed to notice that price is a suggestion until it isn't, that markets are free only when they behave. The personal consequences are not dramatic. They are administrative. Accounts flagged, transfers pending, limits adjusted, access windows narrowed. You will not be told you have lost freedom. You will be told the system is protecting you. This is how control feels when it is normalized. The fallen institution's failure ripples outward, tightening compliance, justifying surveillance, accelerating the migration to programmable money that can be paused, directed, revoked. This is not advice, it is an observation. Silver rockets, they say, as if velocity were the story. The real story is gravity. When paper detaches from physical, it does not float, it collapses. Prices gap, not because of enthusiasm, but because of absence. Absence of supply, absence of trust, absence of a counterparty willing to stand in the middle. The institution that once stood there is gone. Others will follow, not loudly, but methodically, each fall prompting a new rule, each rule narrowing the corridor. Freedom and control are not slogans here, they are accounting outcomes. Freedom requires optionality, the ability to choose form, time, counterparty. Control removes optionality in the name of order. The system cannot recover because recovery would require restoring optionality, and optionality threatens the architecture that now governs. The collapse is therefore managed, elongated, procedural. It feels like stability until it doesn't. In 1933, the order was given. In 1971, the window was closed. In 2008, the losses were transferred. Today, the mechanism is subtler and more complete. The major institution has fallen. The silver market has spoken. The response is already written. When the screens resume and the language resets, the world will look the same. It will not be the same. The silence is the signal.